if we look back back to the great financial crisis, every downturn, 2008, 9, 15, 16, and then COVID 20, the reaction was always stimulation through real estate markets. And that channel has that no longer exists to that degree, simply because there is overinvestment, massive overinvestment. There's a leverage problem that needs to be worked down, not increased. So that channel has ceased to exist. And so naturally, what you actually see now, the Chinese government is looking for alternatives on the investment side to stimulate growth, and that mainly channels through infrastructure investment, basically renewable infrastructure and so forth. I think those channels will be much slower to react. And as such, I would argue the rebound in Chinese growth will be sluggish from here. I think if we talk global inflation from that input, I would argue global inflation is not materially impacted by a rebound in Chinese growth. The commodity side, maybe a bit, but overall not a lot. When you talk about global supply chain and the disinflationary impact, the outsourcing story of China over the last years, I think that's not going to go away. Although we see reshoring, we see shifting manufacturing capacity into Vietnam and other areas, but that's typically just a shift, and that's not going to push up prices meaningfully from here. So I don't think that's a pro-inflationary input.
Mathias, can I pick up on that point? Because even when it comes to, say, India, we know that there's been a strong push, even in the technology world, to put more investment in India to offset China, this whole change in supply chains. But at this point, wages more expensive in that country. As we try and navigate what is a very long-term and medium-term theme here, who is well placed to withstand any increases in the supply chain costs as a result? Is it the United States or is it Europe?
Well, I think Europe is a bit disadvantaged in the medium term simply because of the energy side of things. I think the crisis has been averted by quick reaction, but over the medium term, we will have to deal with higher energy costs, mainly from the gas side. And that energy transition will take time, more than 2 to 3 years. So I think, you could argue Europe is a bit in a disadvantageous spot here, but typically companies which operate in those markets are very capable of finding solutions, be it by moving production elsewhere, by sourcing cheaper energy and so forth. So I'm not too worried about the company landscape, although that cost burden will be carried by the overall economy. When I look at the US, I think they're in a very well positioned from every aspect. You have some reshoring, you have on the energy side a lot of security, and then you have inflation, which is rather receding than increasing. So I think the US clearly is a bit better positioned at this point.
Mathias, can I ask you about banking names in particular? Because I was reading a report from DataTrek calling it the canary in the coal mine, the action you've seen this week, and there has been a fairly strong reversal. Banking names on the KBE have been tracking down about 5.7% just this week alone. Do you have any interest in holding any of the bank names, whether it's the US players or the European ones?
Well, we're closely following especially the European banks, the commercial banks. And there, I think, we have seen a strong rebound over the last, 2 months. So I'm not all too worried by a slight pullback we see now. Overall, I think when we look at the banking landscape on both sides of the Atlantic, the capitalization is much better, the funding structure much more resilient. And as such, I'm not too worried that banks will have a big problem weathering any cyclical variation in the economy which is about to come. So at this point, I think the positives still outweigh the negatives, meaning that the interest rate differential business has made a comeback, especially in Europe, and that's going to stay with us for some time, I would think.